Hi folks, welcome to our next topic in the series relating to shares. This topic is known as share repurchase. And when we repurchase shares, under the Canada Business Corporations Act, if a company repurchases or buys back their shares, they need to retire them so they can't reissue them again. The reason we say that is because they could manipulate their share price if they bought the shares back, right? Create a market for their shares because they're buying them back. They're not available to the public. The public may want them. They'll create a market, drive up demand, and then dump them in the market. So, in Canada, we're smart here, and we don't allow that. So we have companies retire them once they repurchase them. That's why I said here, a lot of times when we refer to share repurchase, you'll notice even in your textbook, the next topic is share retirement, or what they call share buyback. So share retirement is really our topic, and it's also known as canceling the shares because we have to retire them or cancel them. Share retirement, once you do that, you're canceling the shares, you're taking them out of circulation, so that actually reduces the number of shares issued and outstanding. So when you're doing the equity section of your balance sheet, you're going to find fewer shares are issued and outstanding. In the previous examples we did with share dividends and share splits, we created more shares, or we had more shares issued and outstanding. Here, we're doing the reverse. So let's do an example to show you how share retirement works. So let's assume we have a company, and we're calling it Delta Company, and they originally issued 1,000 shares on January the 1st at $12 a share. At that date, they made a journal entry on January 1st, and they debited cash and credited common shares for $12,000. That's $12 a share that they got from investors times 1,000 shares. So that's $12,000. Let's say now on May the 1st, Delta decides that they want to repurchase and cancel or retire all of those 1,000 shares that they issued on January the 1st. And let's assume that when they buy them back, they retire them or pay the investors back $12 a share, which is exactly what they gave them. So we're assuming here that the price that the investors gave Delta when they bought the shares was the market price of $12. And on May 1st, the market price is still $12. So in other words, we're assuming that when Delta went to its shareholders and said, we want to buy them back from you, they would have to buy them back at a market price, and we're assuming that's $12. So what would we do? In essence, all we're doing is debiting common shares, because we did say when you repurchase or buy back your shares, you debit common shares because you reduce, we said up here, it reduces the number of shares outstanding. Therefore, it'll also reduce what's in your share equity account, your share capital account, which is your common shares, 12,000, and you're going to have to pay the investors 12,000, so you credit cash. Okay? So all we're doing is reversing that out. Well, let's change the numbers on you a bit. Let's assume situation 2. And in situation 2, what we're going to assume that instead of this, pretend this didn't happen. Say that on June the 1st, Delta decided to repurchase and cancel or retire 500 of those 1,000 shares. So let's say situation 1 didn't happen. All we have is on January 1, we have here that we issued 1,000 shares for $12 a share, but now in situation 2, of those 1,000 shares, they want to retire 500 or half of them. And let's say that they can retire them by paying the investors back $11. What that means is that the investors gave them on average $12 a share, but the market price now has dropped. So the company is now going to buy them back at the current market price on June the 1st, which is $11 a share, right? And that's less than $12 a share. So what happens? Well, we take the common shares off of our books at their dollar value. Well, if we got an average issue price of $12 a share, we remove from the common share account 500 shares for which on average the investor gave us $12 a share. So we're going to debit the common share account for $6,000. What else do we know? We know that we paid cash. How much cash did we pay? Well, we paid the investors $11 a share for each of the 500 shares we bought back. So we're going to credit cash for $5,500. So we can see that we're out on the credit side by 500, so we got to plug the hole. How are we going to do it? In this transaction, whenever you pay less to buy back shares than what the investors gave you in the first place, we call that excess, or that extra that you get to keep, contributed capital. All right, it's contributed capital, and it's as a result of common share retirement. So whenever we have contributed capital, we have to say why it's created. So the name of the account includes from common share retirement to distinguish it from any other kind of contributed capital. Okay, that contributed capital account, we've got a little star here, and what we're telling you here is that it is a shareholders' equity account. It's part of your contributed capital section. So some of you might have thought, oh, I can plug that and call it a gain. A gain is never reported as a result of a share retirement because a gain has to do with income. Gains and losses go on your income statement. Whenever it relates to shares, any gain or loss is usually adjusting what we call contributed capital. So the rule here is that whenever it costs you less to buy back the shares than you originally got from your investors, you're going to credit contributed capital from the common share retirement. That's your account. And that's what we used here. All right. So now let's say we have another situation. Let's say that after June 1st, which was situation 2, after that happened, let's say that on July the 5th, Delta decided that in addition to repurchasing and retiring the 500 shares that they retired back in situation 2 up here, these guys decide we want to retire 200 more in addition to the 500. So now let's say that on July 1st when they did that, the market price has gone up. So now it's going to cost Delta $15 a share to buy them back from the investors, which is more than the average issue price of $12 a share, which is what they gave them, right? So now what would that look like? Well, if we were on July the 5th to adjust our accounts, what we would do is we would have to debit or remove or reduce the common share equity by the amount of the shares that we're retiring times what we call the average issue price. The average issue price is the $12 a share, which is the amount on average that the investors gave you when they bought the original 1,000, of which you are now retiring 200, right? So it's now cost you more. We said it cost you more to retire these shares. So your cash is going to be credited by 3,000. How do we know that? Well, it's 200 shares you're retiring times $15 a share that it's costing you to retire them. That's what we gave you in the question. So we're going to credit cash 3,000. So now what do you see? We're a little light here on the debit side. So what do we do? Well, the first thing we do is we look at our contributed capital. Why here? Because in the previous transaction, we had contributed capital. So whenever you have contributed capital, if you need to draw down on it or use it up, you can do that. But you can't debit contributed capital if you have none. You can only debit the contributed capital on July the 5th because you can see from the June 1st transaction you created it. So you draw down on whatever contributed capital you have first, which is your $500. So in this case, we're going to draw down on the whole 500. Why? Because we need it all in our attempt to plug the hole on the debit side because we're a little bit light, right? We need to plug it. But it's not enough because with the $2,400 in shares that we're taking off our books, the $2,400 plus the $500 we used up in the contributed capital, we're still short by $100. And to make up that shortfall, we debit another equity account, retained earnings. So, what's the rule? The rule is that whenever it costs more to buy back the shares, which in our case is $15, as opposed to what you originally got from your investors, which is on average $12, what do? You can debit your contributed capital from the common share retirement account only if you have enough that was created from a previous share retirement. So in this case, we needed to use the whole 500. If we didn't have any contributed capital from share retirement, so if it didn't have a credit balance, we can't debit the account because we've got none. The only reason we could do it here is because we had it created on June the 1st, so it's still sitting in our accounts, right? So if that's not enough after you debit the contributed capital, if you still don't balance, then you can debit retained earnings. So the rule is you got to draw down on contributed capital first, but you can only do it to the extent that you have it. So if you didn't have 500 in contributed capital, then you couldn't draw down 500. If you only had 300 in contributed capital, then you can only draw down a maximum of 300 if you pay more to buy back the shares than what you paid. So it depends on whether or not this account actually has a balance, and its normal balance is credit. So you can't debit it unless you have some of it already. You have a credit balance of some kind. Okay? So now with that theory in mind, you might want to take a little break, go for a smoke break, a little beer, glass of wine, whatever floats your boat, and come back because now we're going to do another example of share retirement. So feel free to take a little break if you need to, pause the video, but for those of you who are going to stick in here, then you know what? We're going to do the video for you now, which gives you another example of share retirement. So now in this example, let's say we have a company, it's called Amex Inc., and they have 180,000 common shares that were issued and outstanding at December 31st, 2014. At the issue date, the investor paid Amex $9.80 for each share. Into 2015, specifically on September the 12th, Amex decided to repurchase and retire 40,000 of those 180,000 common shares, and notice they bought it back at a lower price than what the investors gave them when they bought the shares. So this must be the market value now. When the shareholders bought them, it was $9.80, but now it's costing the company less to buy them back from the investors because that's the market price. And it's the first retirement that the company ever had. Why is that significant? Because if it's the first retirement they ever had, they probably don't have any contributed capital from common share retirement. They don't have that account because this is their first retirement. So now, in addition to that, Amex also repurchased and retired 20,000 of the remaining shares at $11.40 the following December 17th. We want you to record the entries on September the 12th and on December the 17th. So let's do September the 12th first, because what you can see here is that on September the 12th, we're buying them back from the investors at a price that's less than the average issue price, whereas on December the 17th, we're buying them back at a price that is more than the average issue price. So we have $9.80. So we got to think this through. So do one at a time. So remember, on September 12th, the price to buy back the shares is less than the $9.80 that we got from investors when Amex originally issued the shares to their investors. So the rule is, I'm just repeating the rule from up here. Okay? Whenever it costs less to buy back shares than you originally got from your investors, you're going to have to credit contributed capital from common share retirement. And that makes sense because for 40,000 shares, we're going to take them off of our books at $9.80. So that's the first step. So 40,000 times 980 is 392. So we debit share capital, or our common share account, for $392. It's costing us $9.10, which is less than $9.80 to buy them back. So our credit to cash is going to be $364. So we got a hole to plug, right? So we're going to plug it for $28,000, and according to our rule, we're creating contributed capital from common share retirement. So we have to credit this equity account for $28,000. Okay? Now, let's go do the December 17th example because that's a bit different. On December 17th, what does it say? On December 17th, it's costing us more to buy back the shares because the market price has gone up. We only got $9.80 for them when the investors bought them. So the investors are selling them back to us at $11.40. So now don't forget the rule. When it costs you more to buy back the shares, the first thing you're going to do is you're going to debit any contributed capital you have to the extent that you have it. In our case, we have $28,000 in there right now, but we can't debit this account for $28,000 or for more than $28,000. We can debit it for less than $28,000 if that's all we need. We can debit it for $28,000 if that's the exact amount we need, but we can't debit it for any more than what we have in it. It's just like you guys. If you've got $500 in your bank account, let's assume you don't have any overdraft protection. If you want to take out that $500, that's all you can take out. If you want to take out $200, that's okay. You can do that because you got $500, right? But if you want to take out more than $500, you can't do that, right? Same thing here. We have $28,000 in contributed capital, and because it's costing us more to buy back, our rule says that you can debit it, but you can't debit it for more than you have. So what does the entry look like on the 17th? We're going to remove common share at its dollar value of $196 because that's for the 20,000 shares we're retiring on December 17th. Remember the question? It said here that on December the 17th that we were retiring 20,000 shares at $11.40. That was in our question, right? So now what we're going to do is we're going to debit the common share equity for $196. That's 20,000 shares, and we remove the shares based on the average issue price, or what the investors gave us for them, which was $9.80. That's your $196. Well, how much is it going to cost you to retire them? Well, it's costing you more than $9.80. It's costing you $11.40, so you're going to have to credit your cash for $228. But $196 debit and $228 credit, that's not in balance. So what do? We're going to debit contributed capital first. So now we got our little bank of contributed capital, which has got a balance. The question becomes, how much do we need? We can't use any more than $28,000. So do we need it all? Yes, we do. Because if we debited it for $28,000, you'd see you're still going to be short by $4,000, because these two numbers added together are only going to give you $224,000, right? These two together only give you $224,000 on the debit side. You need to balance against the credit of $228. So you got to debit another account for $4,000. So once you've used up all your contributed capital, the only thing, if you still don't balance after that, you got to debit retained earnings for the difference, which is $4,000. Okay, so now this concludes our discussion on common share retirement. So you can check your eLearn course because there are other videos. So if you look at your handout or you go into your eLearn course, in the script there is, in the handout material, the script, there is a list of other videos that you can look at on share retirement. All right, you will also find some homework available for you on share retirement and maybe even share dividends and share splits. So make sure that you go into your eLearn course and you get whatever homework that I've assigned to you, okay? So now, thank you for listening. I hope you found these videos helpful, and have a nice day.